Explain this to me because I don't fully understand it. Freddie Mac and Fannie Mae, that you, Gingrich Productions, or Gingrich Group rather, received a significant amount of money from Fannie Mae and Freddie Mac. Tell me, first of all, how much money was it?
Well, I'm not sure the exact amount, but the reports are it's about $1.6 million. We're trying to work that out. I just don't have the numbers.
The Federal Reserve credit created during the last 8 months has not stimulated economic growth in technology or the industrial section, but a lot of it ended up in the expanding real estate bubble, churned by the $3.2 trillion of debt maintained by the GSEs, the government-sponsored agents' enterprises. The GSEs, made up of Fannie Mae, Freddie Mac, and the Federal Home Loan Bank, have managed to keep the housing market afloat, in contrast to the more logical slowdown in hotel and office construction. This spending through the GSEs has also served as a vehicle for consumption spending. This should be no surprise considering the special status of that the GSEs enjoy, since their implied line of credit to the U.S. Treasury keeps their interest rates artificially low.
All right. In terms of Freddie Mac, though, did you spot what was coming in terms of the housing industry crisis? Did you tell them, look, this is a real problem. This is about to blow up on the nation. Did you see that coming, and did you warn them?
You could see in conversations, particularly by 2007, that the loan standards were becoming absurd. That was beginning to be patently obvious. What you couldn't see was that the Federal Reserve would tighten up in a way that you suddenly had a huge credit crunch. And I think that's a very different part of the problem.
The Clinton administration encouraged growth in housing loans that were financed through this system. In addition, the Federal Reserve treats GSE securities with special consideration. Ever since the fall of 1999, the Fed has monetized GSE securities just as if they were U.S. Treasury bills. This message has not been lost by foreign central banks, which took their cue from the Fed and now hold over $130 billion worth of United States GSE securities. The Fed holds only $20 billion worth, but the implication is clear. Not only will the Treasury loan to the GSEs if necessary, since the line of credit is already in place, but if necessary, Congress will surely accommodate with appropriations as well, just as they did during the savings and loan crisis of the 1970s. But the Fed has indicated to the world that the GSEs are equivalent to U.S. Treasury bills, and foreign central bankers have enthusiastically accommodated, sometimes by purchasing more than $10 billion worth of these securities in 1 week alone. They are merely recycling the dollars we so generously print and spend overseas. After the NASDAQ collapse last year, the flow of funds into the real estate accelerated. The GSEs accommodated by borrowing without restraint to subsidize new mortgages, record sales, and refinancing. It's no wonder the price of houses are rising to record levels. Refinancing especially helped the consumers to continue spending even in a slowing economy. It isn't surprising for high credit card debt to be frequently rolled into second mortgages, since interest on mortgage debt has the additional advantage of being tax deductible. When financial conditions warrant, leaving financial instruments such as paper assets and looking for hard assets such as houses is commonplace and is not a new phenomenon. Instead of the newly inflated money being directed toward the stock market, it now finds its way into the rapidly expanding real estate bubble. This too will burst, as all bubbles do. The Fed, the Congress, or even foreign investors can't prevent the collapse of this bubble.
I don't think anybody, whether the chairman of the Federal Reserve or the Council of Economic Advisors or other folks, there were very few people who saw the intensity of the housing problem as it broke loose.
Concerned Federal Reserve economists are struggling to understand how the wealth effect of the stock market and real estate bubbles affect economic activity and consumer spending. It should be no mystery, but it would be too much to expect the Fed to look to itself and its monetary policy for an explanation and assume responsibility for engineering the entire financial mess we're in. A major problem still remains. Ultimately, the market determines all values, including all currencies. With the current direction of the dollar certainly downward, the day of reckoning is fast approaching. A weak dollar will prompt dumping of GSE securities before Treasuries, despite the Treasuries and the Fed's attempt to equate them with government securities. This will threaten the whole GSE system of finance because the challenge to the dollar and the GSEs will hit just when the housing market turns down and defaults rise. Also, a major accident can occur in the derivatives market where Fannie Mae and Freddie Mac are deeply involved in hedging their interest rate bets. Rising interest rates that are inherent with a weak currency will worsen the crisis. The weakening dollar will usher in an age of challenge to the whole worldwide financial system. The dollar has been the linchpin of economic activity, and a severe downturn in its value will not go unnoticed and will compound the already weakening economies of the world. More monetary inflation, even if it's a concerted worldwide effort, cannot solve the approaching crisis. The coming crisis will result from fiat money and monetary inflation. More of the same cannot be the solution.